Welcome back, everyone, to another episode. Today, I'm going to walk you through how I personally analyze real estate deals. Let's get started. Welcome back. Today's episode is going to be a good one. I often come across clients that know that they want to invest in real estate or some sort of real estate investment, but don't really know how to get started or measure the right deal or how to measure a deal in general, right? And of course, we do sell those tools on our website, which you can check out. And again, in our masterclass, we do go through the proper way in depth how to measure a deal or a market or any of those items. But today, I do want to just go over high level the basic process that I use to analyze a real estate deal. Now, I have another video that I'll put above here that talks about generally how to look at a market of choice. The first step is, again, you decide that you want to invest in real estate, great. The next thing is you got to select your market of choice. And then within that, your micro market, and then the product of choice. And again, we have another episode that goes into that. But for today, this is about once you have the market, once you begin to go out in the market to try to find the right property, how do you look at a deal? And you hear a lot of common phrases like cap rate, cash on cash ROI, rent to value ratio. There's a lot of numbers and noise out there. And I think what I want to talk about today is what actually matters, okay? So first, I want to talk about back in 2008, a lot of people that were investing in the markets, not a lot, but there were a number of people that were investing in the markets, and they were buying properties that were slightly cash flowing, all in the hopes of continuous appreciation, right? And I always say I'm not a home run chaser, and you shouldn't be either. So the first thing, just like a stock, for example, is you want to be buying properties that have strong fundamentals. Okay, now what does that mean? So if you went to a property, would you personally live in that property? That's just a quick gut check from the curb. What is the marketability when you go to sell a property, and what is the marketability to tenants? Okay, now this is not something that you can quantify very easily, but in general, does it have the aesthetics that would attract someone to want to move into the property? Buying a 4 or 5 bedroom property probably isn't the best idea, right? There's a select amount of people that want to own that size, but not for everyone. Buying a 1 or 2 bedroom property is also probably not ideal. There's only a select amount of couples or single people that want to own or rent those properties. The sweet spot is really a 3 bedroom, 2 bath, 1,500 to 1,800 square feet home, okay? And that can be a 2 or 1 story home. Now, beneath that all, you want to make sure that the big 5 are in good shape, or if not, then take price concessions on those prices to reflect that. Those being foundation, those being plumbing, electrical, the roof, and then the HVAC system, okay? So assuming those are all in good order and you put in the offer, what should the numbers represent? And there are really 3 or 4 main components that make up what is known as the total return of real estate, okay? Now, there's a number of ways to look at this, but in general, the big 4, the first one's pretty obvious, and that is cash on cash return. And what this means is if you invested $30,000 into a property, let's say you made $3,000 over a 12-month period in net cash flow. So that's rent minus, mortgage, minus interest payments, minus insurance, minus maintenance, minus all the operating expenses. Your net cash flow would equate to $3,000 per year. Now that's a 10% cash on cash ROI, or return on investment. Now I think in today's market, if you're anywhere between 8 to 14% cash on cash ROI, then you're probably in a good deal from that one variable perspective, okay? So, anything below an 8%, it has to have substantial upside. So you think about markets like Dallas or Austin, these have substantial upside. Phoenix is another one. So I might be willing to take a little less cash on cash ROI for a much bigger upside in the future. But the upside is riskier to bet on than the cash flow, okay? That's important to understand. So the first piece of the return is your cash on cash ROI. The second thing to understand is that when you buy a rental property, let's just say you're buying for generally the $100,000 to $200,000 range, your tenants are going to be paying your rent, and you'll be paying the mortgage as part of the operating expenses. Now, every payment you make is probably providing somewhere between $250 to $400 a month in equity, right? So meaning they're paying down the loan for you. This is known as equity paydown. This is another component of the overall ROI. And when you put it into perspective, you have 6 to 10% coming from cash on cash. From the equity paydown, you probably have another 6 to 10% ROI coming from this. And this is one of the beauties of real estate, is they're paying your debt for you if you took out a fixed loan, right? So again, cash on cash ROI, component 1, you have equity paydown, component 2. Now, part of equity is depreciation, and it's really a bonus variable in the overall equation. It's a bonus if it does appreciate, but if you use the logic that we use in picking our markets, you're probably okay to expect some sort of appreciation. In fact, over the course of time, measuring the US real estate market, the average appreciation rate year over year is 3.4%. Okay, so at the very least, I think it's fair to assume that in stable markets that we invest in, that we help our clients invest in, you're probably going to see a 3 to 4% appreciation rate annually. Now, again, that's going to be part of the overall ROI. Okay, so that's another piece. The fourth piece I'll talk about is, it really all depends on your overall strategy, but if you have it set up correctly, there's a chance that you can take additional tax or taxable losses from real estate. Now, real estate is interesting, and we have more videos about tax strategy within real estate, and we have a guest, Tom Castelli, my personal CPA, that we talk about those moving parts. But real estate's beautiful in the sense that the IRS allows you to depreciate the asset. Even though it's appreciating, they allow you to take a depreciation schedule on the asset and write off the rental income or profits that you make. So if you have $3,000 of depreciation for the year, and you have taxable income of $3,000 for that rental property, that depreciation is going to wipe away your taxable liability. So there's tax savings in investing in real estate. Now, this is a paper loss. Keep in mind, depreciation is not a real loss, but it's one of the key mechanisms that makes real estate so attractive. Okay, so, and there's more advanced tax strategy that you can use, things such as cost segregation, bonus depreciation, that can actually go further than wiping off just your profits. In other words, if you're a W-2 earner, you can only take passive losses, meaning you can only write off as much as you made from the rental income. Okay. Now, if you are not a W-2 worker, you have ways to claim yourself as a real estate professional, and you can take losses beyond that, which actually will reduce your overall taxable liability to the government. Now, this is a quick way to make returns. So, again, this is a more advanced strategy, and so I encourage you to talk to your accountant. But it can be a powerful piece of the overall equation, making real estate one of the most attractive, if not the most attractive, asset of choice from my perspective. So again, generally when you combine all of these variables together, your overall ROI in real estate is probably somewhere between 16 to 25% annually. And this is why real estate, in my opinion, is one of the best assets to invest in. It firmly beats the stock market year over year. And in general, it's a way to substantially accumulate wealth, because you're able to do things such as leverage with loans and really scale up your operations to about 10 loans per the guidelines of Fannie Mae. So my point is, that's how I look at a deal. I look at all the angles, the cash on cash ROI, what do I expect from equity pay down, what is the upside of that market, and ultimately, how can I use this in my overall tax strategy? Okay, so if you like what you heard, give it a thumbs up and be sure to subscribe. We'll be having more content like this coming out in the near future. Thanks, everyone.